I think the most optimistic viewpoint right now is that that we maybe are getting back to a little bit of normalcy. You know, when I saw the print of CPI, the Consumer Price Index, come out yesterday, I went on. We'll take a look here in just a second. But I remember, I looked at it for the print for November, and I looked back to previous years. Going back the last 5 or 7 years. A very kind of typical November rate of growth, and then thinking about that, the two buckets that were growing, food and housing. I can't speak so much for food, but at least housing, we've actually seen a lot of declines and negative growth the last quarter or so. And so we've talked about the way CPI calculates housing, not the most intuitive, up to date number. So in the reality, maybe we're seeing a little bit of actual deflation, and what the Fed has been doing with raising interest rates is actually having an effect on the economy.
Yeah, I think that seems very likely. It's starting to strain credulity at this point that the Fed will have no effect, and it's been steadily raising interest rates for the better part of a year, and so I think that now that we're really starting to see it, and it's not a case where jobs are shedding left and right. It's things are tightening a little bit, and I'm not going to say soft landing and mean it, but it definitely looks a lot more likely that things are going to ease up rather than crash down to earth.
Matt, let's actually just go in and take a look at this report real quick.
Yes.
Because you see here, so we're 7% year over year, November 21 to November 22, 7.1%. Increase. Now, that's a lot, but we had a lot of growth earlier in the year, November last year, but only month over month, it's actually negative. I think we're at a point where folks, not just in the investment world, the business world, but people all over the world are starting to feel the pain of these higher interest rates. I mean, immediately, first-time home buyers trying to buy a home. Obviously, they've been feeling pain for a while. People in the tech industry who are going through layoffs because their valuations are all messed up and they've got too many people, and just non-profitable companies aren't in favor right now. Yeah. But with the higher interest rates and with that the strength of the U.S. dollar, the individuals that are really going to be affected, it's not just individuals, but it's the developing world and a lot of much poorer countries that are having to import everything's, almost everything is based on the U.S. dollar. That makes things more expensive for them. They're loaded with debt already. Many of these countries are, almost insolvent. And we've been in a, free money, zero interest rate environment for so long. A lot of things have been able to get by. But now they're having to, the cost of that debt and carrying that debt has increased, significantly. And so for a country like the United States, we've got our, $30-some trillion debt. That's not going to be easy for us either, because as that debt rolls over, we're paying a higher interest rate. But again, think of these small countries who have a ton of debt. Yeah. Their interest payments are going up. They're not going to be able to afford they can't afford anything. They can't afford these new payments. So there's people, countries, institutions are starting to feel pain. And they're looking at the Federal Reserve and central banks, but especially the U.S. Federal Reserve. They're saying, enough is enough. Your goal of slowing down the economy and getting inflation in check, you take a bow. You've done a lot of that.
Yeah, it's interesting because I said this before. I always think of raising interest rates in the terms of buying houses. Well, less people will buy houses. Yeah. But it is really the aggregate of all of these small decisions that people and businesses make. Do I want to put this on credit? No, that's going to be a little bit more expensive to me. Yeah. And I think it's starting to catch up. So whether it's businesses that want to invest in a new department or or they want to found a new company and they need financing for it, or a multifamily syndicator wants to make an acquisition. Maybe they're less likely to do it at a higher price now, and they're coming down. They're like, well, I'm going to say no now until I get a lower price. Before, they were like, well, yeah.
Well, and then they can't. And they could make it make sense. It's like the returns didn't work, and you'd have to do so much speculation to justify it, and fewer and fewer people are willing to do that. There were some earlier this year that were, but I'm hearing whether it's seeing people, owners post on LinkedIn of being like, the Federal Reserve needs to stop this. And I'm like, well, you've got a handful of floating rate loans out there. You've seen your rates adjusted every single month, and it does suck. It hurts. But it's because we are withdrawing. We're in a state of withdrawal from being addicted to zero interest rates, free money. I mean, we've been addicted to it, and governments around the world have been, including the United States government, have been absolutely addicted to it.
Yeah.
And we're going through withdrawal, and we're seeing kind of normal economic activity and kind of the gravity exists taking place.
And I think withdrawal is a really apt term, because it's not like typical psychology where everyone, it's different. And so I'm going to complain a little bit. We have had easy money for so long that
we've been dependent.
Yeah, that it really has fostered some dependency. Yeah. And this is something we haven't seen for decades, interest rates this high. So, I think that a dramatic reaction is in the cards still.
But you're seeing, I guess, the good side of this is you're starting to see some of these signs of normalization that we're hopefully going to lead to less volatility and people being able to make decisions about the future, that's been the ice that's been thrown on everything. Is like, I can't make a major decision because I don't know the situation is going to be in 3 months. Yep. But now maybe they're not going to decrease rates right away unless something really drastic happens, but at least it's going to flatline, and it's just going to go, it's just going to be a flat line. There's not going to be further increases. You can at least plan, and that'll allow asset pricing to finally fully correct. And I think we're anywhere between 72 and 80% of the way there for a price correction. We're seeing cap rates rise. There's still a gap in many cases, but we're seeing more and more deals now coming up of having much more reasonable cap rates. Often, we looked at a deal yesterday and it was still, mid 4 cap. I'm like, not a great location, and semi quality asset. No, we're not. Who's going to be buying? Or you certainly should be. Who's buying right now at a cap rate, 7,500 basis points lower than your interest rate right now in this environment? It's not a prudent or wise thing to do unless you really know something that everyone else doesn't know. There's certainly circumstances out there, and cap rates don't mean everything, but we're seeing more mid 5s caps. I mean, we bought 6.5, almost a 6.5 cap, last week. So I mean, it does exist, and brokers and sellers are starting to understand the reality. And you're either at a point of, well, I have to sell, and it is what it is, and the market's gonna set the price, or you can hold on. And most people who can't hold on are choosing to hold on, and it's creating the kind of the precipice of a great opportunity of these assets that are going to need to be sold, whether it's debt coming due or some other situation where they don't have a choice. And there's going to be a lot of folks that are breaking even. Some people even taking a loss on assets. They just didn't set up the right way to weather through this storm. At the same time, there's so many buyers that are lined up ready for those opportunities. And so I think that there's going to be a very brief time of getting some really good deal, some steals, like just blockbuster home run deals that are going to build absolute generational wealth for those people, buyers. And then it's going to kind of go back to normal.
Yeah. I think and this is something I think you said last week, is the difference between now and early in the pandemic. Yeah, there was a little bit of a wait and see dynamic now, and there was definitely a wait and see dynamic at the beginning of the pandemic. But interest rates makes the math wrong, and that's the real reality. Like, you can convince someone during the pandemic, like, you can actually say, like, these are great assets and the money's right, but now, like, the math doesn't work and you can't change those numbers. You can imagine different scenarios, but the numbers.
Yeah, in the pandemic, it was like the government's like, whoever, the banks are like, we're basically paying you to buy these assets to lock them in, and like, you have to wrap your head around the uncertainty of COVID. But if you were like us and you're like, okay, this is going to be not maybe good for the economy, but all right, people still need a place to live. These are great assets. The worst case, the big concern for a brief period of time was like, well, nobody's got a job, nobody's gonna be able to pay rent. But again, are we gonna go for a decade of no one having a job, and then the government stepped in and gave people more money than they ever made before, and which is why we're in this situation to begin with. But it's a different scenario where the money's not free. You got to actually pay up a lot for this debt. And so the business plans have to make sense. You actually have to buy right. You can't just say, well, we're going to buy it because we're going to get so much rent. We're going to get so much rent growth this year, and cap rates are going to compress a little bit more, and it's going to be worth $10 million more, even if we run it into the ground. It doesn't matter. And I can pay whatever. But now it's like, no. Your basis matters, and that's where this period of price discovery that we're in right now is really interesting. And I see ourselves, great capital, an active participant of figuring out, okay, where are the price of these assets? And so sometimes, we get sent deals from brokers all the time, and sometimes it's a deal that's like, we're so far away, whereas maybe it's not the perfect asset for us. But sometimes it's like, no, let's give them a price. Let's give them a price. They need to know. The brokers need to know.
Yeah.
The market needs to know. The sellers need to know that this is where we are. And we're not just tossing just stuff on the wall.
Yeah.
We've got very empirical and straightforward numbers driven reasons of why the price has to be where it is. And it's $8 million different, but we're not the only ones seeing this, and you need to know this is where the market is right now. Yeah. So you need to come closer to us, or you need to decide not to sell. But we're certainly not a buyer at a 4 cap for
and that is a really good point. It's like it's not like it's not like the price of a value meal at McDonald's where like these things are turning around so much and so quickly you can kind of reach an equilibrium. Like there are, a half dozen or a dozen buyers sometimes, maybe less, maybe more. But that's, each one of those is a significant input for things like price discovery. So
they make it, back in 21, they might have gotten 20 offers, 25 offers, something like that. Which is a lot on a a 20 to $100 million asset. Now they're getting maybe 2, 3, 4, 5, 10 max. And so it is important, your input. And I think it's folks that are out there, they're trying to buy properties. Sometimes can be hesitant of like I don't want to offend them with this number. Well, if you're working with if the seller is represented by a broker, you can always have a conversation of, hey, look, this is way lower. If you don't want me to submit my number, I won't, because I don't want to offend anybody. Yep. But we've got our process. But I'm happy to share your number. I'm happy to share with you our thought process, our assumptions. We'll even share with you our model to show you exactly how we arrived at this price. I don't know how many times our acquisitions team has said, the brokers have thanked us, even though it's like, this price isn't going to work because the seller needs X. Yeah, they've said, this is really great. I need to know this because they need to know how buyers are looking at it, how the market's looking at it.
Learn if you do. Yeah, it's like you don't get the job. At least you ask the interviewer, all right, what did I get wrong? Most times they're not going to get back to you, but it's a good. That's how you learn.
And then it's how we learn. It's how everybody learns. And then the broker's taking that information to the seller and saying, look, this is where folks are. It's hard for them to justify your price because of all of these reasons, and because the broker doesn't want to tell the seller, hey, I don't think your property's worth that. It's much easier to say, well, these are the offers. Or it's like, I didn't even want to show you this offer, but, actually we had 4 come in that are, at, 10 million under. So this other price that is 4 million under is actually a really good offer. Like you should not be offended by this because the market is kind of within this range, and this is the highest end of the range, even if it's at your low end of the range. Yeah. It's actually a good price.
So, and I said this earlier. It's like, I don't really envy the role of the broker. It's hard work.
Yeah.
And it's not just like, I just answer the phone and connect buyer to seller. It's like, no. You have to know so much, you have to be able to kind of smooth that relationship and be able to communicate really accurately. Yeah. But in all, kind of returning back to the CPI numbers, I think they're really, they're incredibly promising, and I think that it is more of a done deal that we're going to get a 50 basis point rate hike, and I see some signs of the clouds clearing, but I don't know if we're completely out of the woods yet. Even though we might be, even if it was zero and we're kind of coasting, we're still at a high level of inflation. 7.1 year over year inflation is still big. It's got to burn off.
I agree.
A while.
I think we need to see a trend. So I think in December, which is typically like the slowest month, of growth, if we see a continued trend, if that's the case again, okay, I don't think it's going to be everything, but I think February and March, is going to be the real indicator of how inflation is going to look the rest of the year. Because March, things should really start picking up. Now but the Fed may be over with the rate hikes by then, because of the idea is maybe another 50 basis point in January, and then maybe a couple 25s. Trying to get to that terminal rate of maybe 5%. I think that would get us to. I think that would basically get us there. And so, are they going to get the information in time to say we're going to hold off?
Yeah.
Below 5%, or is 2 or 3 months enough data to show the trend? And the last thing they want to do is to have to reverse course again.
I think that they're smarter than the numbers. For CPI, especially when it comes to housing.
Yeah, it's not like,
I think they know. Well, and that's another thing too, is housing's still high. Rental housing is still high. CPI is still looking like they're looking, at a dinosaur fossil instead of what the current market is, and they're still showing housing or rental housing costs as moving up 0.6%, which is pretty significant. You analyze that, it's like 6 or 7.2, really, yeah. So it keeps plugging along, and it's bound to, within the next 3 months, start going down. Because it's about like a 12-month, maybe 9-month lag between the shelter prices and when it finally circulates back into back from the interest rate hikes that we're seeing.
Absolutely, and again, the shelter makes up 30%, 32%, almost basically a third of CPI. So it's not like just like a minor piece that is throwing the whole number off. Again, if shelter was a more real-time, higher frequency, indicator as a part of CPI, again, like we would have a negative number.
We could have 0.3, 0.2, 0.3 negative. If this is a third, this is horribly bad math, but if you cut that by a third, that's like 7.1 by a third. I don't know. It seems like that's a negative. Yeah, it's less. It's less.
It's less.
Man, that's my liberal arts degree going.
Yeah, it's all good, Matt. That's why we got Excel. So I think we're going to be waiting out for next month's December print. We'll see if it's lower. It should be, and we'll keep tracking it. And again, everyone's waiting for Jay Powell's notes.
He makes the future. We try to predict it, but he can just create it.
Well, and again, as we've talked about it, it's so much of this is just psychology and messaging.
Yeah.
And he has they've done an effective job of starting at that Jackson Hole speech of saying like, no, we're doing what we need to do, and it's going to be painful, and just buckle down because we're doing it, and we're not going to blink.
And I think that's such an important role for them is if we're treating these announcements as a foregone conclusion, then they're doing their job right. And they kind of I don't think that they want surprises like that, and they have done a great job of signaling what to expect.
Well, I think that's the key point. If you're going to signal, you better be very clear and not move around. Well, either that or shut up. Because Fed officials in the past used to not say anything at all. It was like, here is what it is. We're going to go back into our room now.
Yeah.